Well, good afternoon, everyone. Welcome to Stone Rudolph and Henry. We're glad that you've joined us for this seminar on Social Security planning and retirement planning. Hope that we can answer some of your questions for you. Wanted to let you all know that we have an event coming up. It's our Community Shred Day. So if you have old records or papers or anything like that that you need to get rid of and open up some space in your home, that will be September the 29th, which is a Friday, from 10 to 1. And we ask that everyone limit your amount that you bring to 4 boxes or 4 tubs or whatever, so that we can, keep a line flowing and make enough space for everyone. So we hope that you can come for that if need be. Also, we have a seminar coming up September the 13th and 14th on healthcare changes and solutions, and we hope we have some by then. We don't know what's happening from day to day, but Buddy Smith is going to be here to lead that seminar, and we'll be getting information out about that within the next week by email and our social media. Speaking of social media, we are on Facebook and LinkedIn, so we invite you to go on and like our pages, because we're constantly putting out tax tips, financial planning tips, all of the services that we provide. We put tips and information out there for you to keep you updated on all of the things that services we provide for you. So go on and like us on those. And like I said before, the bathrooms are down this hall. Feel free to get up during the seminar if you need to. And we are going to be, we are airing live right now on a webinar. So that's the reason I'm on a mic. He's going to be on a mic. So if you have questions, I'm going to be running to stick a mic in your face so we can hear your questions. So hope you don't mind, but that's for the purpose of those listening by webinar, so that they can hear your questions and understand what's the information that's going out at the moment. So is there anything else that we needed to put out there? Okay. Well, Clint, it's your turn.
Thank you. Yeah, hold. Is this working? Test.
Yes.
Okay. I feel like I'm getting ready to sing, so please no requests. No requests. Now, my name is Clinton Hauser. I'm a CPA here at Stone Rudolph and Henry, and I'm just going to be covering Social Security. Ooh, could we turn these lights off, if possible?
Yes, I'm sorry. There we go.
There we go. Kind of, how it works. Going to do some important terms, some deadlines, timing issues, and, of course, like the taxation of Social Security. And then we're going to end up with some thoughts on retirement planning. And I don't want this to be a lecture, where I'm lecturing you. I kind of like it to be maybe an open discussion where if you have a question, please feel free to ask, because I'm going to be throwing a lot of information at you, covering a lot of topics. So I want to make sure if you have a question that it gets addressed and hopefully answered. So at any point, if you have a question, please feel free to speak up. Give you a little bit of background on SRH. Excuse me. We are celebrating 63 years in public accounting. We do have the largest CPA firm based out of Clarksville here, and we have offices down the road in Brentwood as well. As you can see, we offer a multitude of services. We are a full CPA firm. We have the tax planning and preparation. That's individual and business taxation. We have everything from estate, gift, trust, taxation, and planning. We have our full audit team that handles financial statement audits, reviews, and compilations. Also have the CAS team, Client Accounting Services. That'll handle a lot of your monthly, your payroll, licensing, all the, maybe monthly reports that need to be filed. Also have QuickBooks Pro advisors on staff for those of you that get completely lost like me in QuickBooks. So you just go find a QuickBooks Pro advisor. So then we have a complete technology support and monitoring services, which I'm actually getting as I talk, getting my technology support and monitoring service. So as you can see, it's one of our goals is if you run into a problem, you have a situation or a question, we're the ones that you feel comfortable giving a call. Cover the legalese before we get into our topics. I am in no way employed by, affiliated, or endorsed by the Social Security Administration or any other government agency. And all of the examples I've brought are hypothetical. They're just for illustrative purposes, and your results will vary. And at no point am I here or anyone here to sell you anything or to try to push anything like a product, insurance, security product. We're just here to hopefully educate you and answer your questions. So I started with this slide. You know, it's just for me. It's helping me relax a little bit before I start. Now, I put this in there because it brings several key points about retirement planning to mind. First thing is retirement planning can trigger an emotional response. You know, it's a very emotional subject because I remember being 20, thinking, I'm going to be a billionaire by the time I'm 30. I do not need to worry about retirement planning. And then at some point in my 40s, I rolled over and thought, I don't think I'm a billionaire yet. So I'm like Googling Social Security. Is it still around? So it's emotional when you're thinking about you have a working lifetime, and now you have a period of your life where you may not be able to generate new income. So you have to plan for that. So that's the second picture that comes to my mind here is this is kind of my view of kind of how I see my retirement. It's kind of my picture, my end point. I'd like to be sitting in that chair looking out over the water, relaxing. So what's it going to take for me to make that reality? Because I need to start planning now to make this my reality. And what's this reality even look like? You know, hopefully this pier is attached to my home, a home that I have paid for because I've planned for that. I mean, right now, I think the only thing I have paid for is the chair. But, you know, we're all starting at a different starting point, and we're just going to develop a plan. We're going to follow through with that plan, and that's what I'm going to encourage everyone here to do today. So I've started a PowerPoint presentation with a graph. So I'm pretty sure I'm breaking some sort of cardinal rule here. But if you'll just hang in there, I got some cool little caricatures that come up later. But this is the topic that most often comes up as soon as I mention Social Security. The question is it going to be there when I retire? So we can see from the dark blue line, this is our Social Security Trust Fund. And it's very well funded right now. And it's actually so well funded that the payments being made to current retirees are all interest off this trust fund. But then around 2020 is when the bulk of the baby boomers start drawing their benefits. So then you can see that blue line turns south. Now, this is assuming no changes are going to be made to the system. And even if there was no changes, Social Security is not going to go away because even in 2035, when the trust fund is depleted, the current tax payments that are being made to the Social Security Administration from the working people will cover 77 cents of every dollar promised in benefits. So the checks are still going to be there. Granted, they may be a little reduced, and like I said, this assumes no changes. So that being said, what are some of the changes that are being proposed for Social Security? First one is the increase or the removal of the earnings cap. So if you're not familiar with the earnings cap, there's a limit to the amount of income that you can make that is subject to Social Security. So we have this 6.2% tax on every dollar that you generate in income, whether it be, you know, earned income or self-employed income. You'll have a 6.2% tax, but that reaches a cap. In 2017, I believe it's $127,200. So every dollar above that cap, you don't have to pay you don't have to pay Social Security tax on that. So you can see if we move that cap up or we just do away with it, now we're bringing in more tax dollars to fund Social Security. Another item is to increase the age of retirement on younger workers. So we have the younger workers work a little longer. That provides more income, more tax dollars in. Also reduces the benefits because they can't draw them until they're a little older. Of course, you know, I don't want to be the one to tell my 20-year-old son that he's going to work till 90 to pay for my retirement, but that's on the board. Make the retirement a little older. Also, payroll taxes. This seems to be the popular one that's out there. You just increase that 6.2% until that blue line becomes more horizontal and less vertical. Some estimates say that on top of the 6.2, we'd need about another 1.5% of tax on the to fund Social Security and make the trust fund more viable. But like I said, it's definitely well funded right now, so we can plan on Social Security still being there. So what is Social Security? It's often referred to as the OASDI, Old Age Survivor and Disability Insurance. It was created to provide monetary assistance to people with inadequate or no income. So not the wealthy. It was created for people with inadequate or no income. But on average today, the people retiring today, 40% of their retirement income is comprised of Social Security. So it's really a big chunk of a retirement for an individual. So they've either put in place other investment vehicles, or I'm going to refer to them as buckets, like IRAs. They've got other retirement making up the remaining 60%, or they're just reducing their standard of living to live off the 40%. So during your working period, and I mentioned this, you pay taxes into Social Security. That's that 6.2%. And then that money is used to pay benefits to people who are already retired, disabled, even survivors of workers who have died, and then the dependents of those who have died. So it is spread out among a variety of people. And benefits paid, this is what you get. It depends basically on two things. Excuse me, your earnings record, how much you've paid in during your lifetime, and the age upon which you choose to receive those benefits. So that's completely in your control, the age at which you determine you're going to start receiving benefits. Those two things is what determines the amount you're going to receive. So you're going to hear all these different terms: qualified, insured. There's all these acronyms, and I've actually given you a sheet in your pamphlets there. It's a acronym sheet. It kind of defines some of these acronyms that we're going to see, because it's almost like the military came up with Social Security because of all the acronyms. Because, we're going to cover like AMI, which is your average indexed monthly income, earnings. So you have your AMI. You'll hear FRA a lot, which is your full retirement age. That's kind of important. PIA often comes up, which is your primary insurance amount. Then you have like NAP, which I think is what everybody's going to take if I keep talking about acronyms. So no, there's no NAP. But so do you qualify? How do you become qualified? Because you actually have to qualify for Social Security, and they're going to call it insured. It's basically you earn these credits. So you get one credit in 2017. You'll earn one credit for every $1,300 you generate in income. But you're limited to 4 credits a year. So that kind of forces you to work about 10 years before you can qualify for Social Security. And that's what most people need, is about 40 credits. But once you reach that, then you're qualified. Now, how it's calculated, that's a separate topic, and it's important that we understand kind of how it's calculated, because you're going to be making decisions as you get closer to retirement, like, am I going to continue to work a little longer and not draw Social Security just yet? Well, let's look at how it's calculated, and that'll help you make that decision whether you need to do that. So basically, they're going to take the earnings from the highest 35 years that you worked, and then they're going to adjust them for inflation, so they're going to bring all 35 of those years up to today's current dollars, and then they're going to divide that amount, that total, by 420, which is the number of months in 35 years. So that gives you your average index monthly earnings, or your AMI. So once they've determined that, and you might ask, well, what if I only work 20 years? Well, then you're going to have 15 zeros that go into that average. What if you worked 50 years? Well, they're just taking the highest 35. And that's how they're coming up with the amount, the AMI that we're hunting for. Now, I got an example on the next slide, makes it a little more clear, but we're basically going to take Amy and we're going to run her through this 3-tiered obstacle course that's going to reduce her down, because you got these 3 steps, and you'll see how these bend points work, and you'll basically see how the 90%, how each step is applied to a different amount. It's much easier once you see it. So a person earned, say, just for simplicity, $75,000 a year for 5 years. So that's after we went back and adjusted everything. That is your per year earnings, $75,000 a year. So we multiply that times 35 divided by 420. That gives us this wonderful AMI of $6,250, which I saw that and thought, okay, I can live every month off $6,250 in retirement, right? Well, that's not what you get, because remember, you got to run AMI through your obstacle course to get your primary insurance amount. Now that's fancy that's the check you're going to get in the mail. This is the actual amount you're going to receive. And you can see how this tier system works. From $1 to $885, you get to keep 90% of that. So $796 is what you're going to get. So if your AMI was $885, you're going to get a total of $796. Well, then we take it to the next step, that 885 to 5,336 platform step. You're only keeping 32% of that. So you can see how this was geared towards the inadequate or no income individuals. 90% of it gets kept up front, but as you increase that AMI amount, it really restricts down the amount that you get to keep. And then everything past 5,336, you get to keep 15% of that. So that, for in this example, your total check each month would be $2,357. And this is exactly how they calculate it. Ooh, got a question. Ah, good one.
There you go. If you were like a bazillionaire, okay, so that last one would be 15% of the 5,336
Yeah,
to a bazillion.
Well,
And even though you only paid on, what did you say, 100 and
well, for this year,
yeah.
127,200.
127,000?
Yeah.
Yes.
That's why that cap is there.
So they can only go up to that 100.
Correct.
100. Okay, not
'cause
to
actually-
a bazillion.
Right.
Okay, thank you.
Because just for the curious, the max benefits, if you were to retire this year, the max benefits you could get would be $2,687. Because of those thresholds, every year they've capped the amount that you could draw from Social Security. So 2,687 would be the top dollar check. Yes.
So that 75,000, would that be like max at the 127 then, times the 35 years?
Correct. Right. So if you made 75,000 this year, you'd still have room before you hit your max threshold.
So if you made 200,000,
Right.
the most you could use is the 127.
Correct.
Calculate that.
Yes.
Okay.
So where if you made 75,000 back 30 years ago, the max may have been 10,000 that actually applied to Social Security. So that's why that threshold's in there, is to cap basically the amount that you can get. So that's how it's calculated. So now I get a lot of questions like, well, I'm just going to go down to the Social Security Administration and ask them for advice. Well, you can, but what they're doing is they're going to run that calculation that I just described, and they're going to tell you what that amount is, and that's all they can basically do. They are actually precluded from giving you advice on when to take it, whether to delay, to file early, and then the biggest factor is they can't take in account all of your other outside assets. So really they're kind of restricted, and they're basically there to say, okay, this is the amount. If you filed today, you would get this much. So this is kind of why it's important to maybe speak to, oh my goodness, I completely forgot to introduce you, a certified financial planner. This is Brandon Bork. He assists our firm, handles many of our clients, actually handles my retirement planning. Hopefully after this, he'll still handle my retirement planning. But he works with Roussel and Associates, and he's going to give us some thoughts and some comments on retirement planning and items like that. Sorry about that. So this is where we're going to go ask for advice instead of going to the Social Security Administration. But we have three major categories of benefits. That's the benefits. These are different categories that you might find that apply to you. So we're kind of going to go through them, figure out how they work. You have retirement, which is what most people are familiar with, because that's the one that we're dealing with, that how much have you paid in, when are you going to take it? That's your retirement benefit. But then we also have spousal benefit. So in some circumstances that you might find at one point that you're on a spousal benefit. Then we have a survivor's benefit that, like I said, at some point you might find that would benefit you. A good strategy makes the most out of all three. Now, I've been asked before, can I be on all three at the same time? No. No, it's one or the other. It's dependent on the greatest of benefit is the one that you're going to want to be on. So let's go through these. Retirement benefit. Now, this is something I'll need everybody to kind of figure out right now, maybe even write down on your notes. We need to figure out our FRA, our full retirement age. So if you were born during these years, your full retirement age is 66. Now, this is their attempt, Social Security Administration's attempt to extend the retirement age. So beginning in 1955, you have to add 2 months to the age of 66. So a good example would be like if you were born in 1957, your full retirement age would be 66 and 6 months. So you had to add 3 years of 2 months. But then once you hit 1960, or if you were born later than 1960, it's just 67. That's where you're at, is 67. So you'll need to know that as we go forward, because I'm going to talk about possibly filing early or the strategy of possibly delaying and how that works. So you'll need to kind of have in your mind what your full retirement age is. Now, as a caution, it takes up to 3 months for your benefits to begin. So a lot of times people will go down and file at the Social Security Administration thinking that they're going to get their check right then and there. It doesn't work like that. It could take up to 3 months for those benefits to begin, so you need to prepare for that. Regardless of your filing time, you need to file for Medicare. 7-month window. It starts 3 months prior to your 65th birthday. And filing for Medicare has nothing to do with any of the strategies or when you file for your retirement benefits. It's just a separate thing. You need to file for A, which is free, and or B, which could have a cost. And the first opportunity you get to do that is 3 months prior to your 65th birthday. Now, I put a website on here. This is the Social Security Administration's website, and they have done a wonderful job about creating an account that is strictly for you, for your eyes only. You actually go on. As soon as you go onto that, it's going to say sign up. You click that. It's going to ask you for a username and a password, and then some private information. That way they can verify that it's actually you that's signing up for this account. Once you have that, you have your own account. You can log in at any time and see right there on the home page, it's going to list your monthly benefit amount, what your earnings are that you've paid in, and that they're running these calculations on. There's a lot of stuff you can do on this website that applies personally to you. Like you can even file for benefits online now. Basically anything that you could have done walking into the Social Security Administration and waiting those 3 or 4 hours, you can now do online. So like even replacing your, if you lost your Social Security card and you want to replace it, that can be done online. So it's very valuable to have that. Now, we're going to go on. So that's retirement benefits. Everybody's real familiar with retirement benefits, but we're going to get into spousal now because it's something you may not be familiar with, but it applies to couples and how they've set this up and how I'm going to kind of run for this discussion. I'm going to refer to it as taxpayer and spouse. Really, the only difference is for these benefits is the taxpayer worked outside the home and the spouse did not work outside the home. So you can kind of see how this works as far as spousal benefits, because how it's going to work is the spouse can receive up to half of the benefit that the taxpayer is receiving. So the spouse must be 62 years old, and the taxpayer must be receiving Social Security benefits. The spousal benefit cannot exceed 1/2, but really it can't be any less than that either, because they're going to raise it up. Because a lot of times what you'll see is, say the spouse files for benefits, and they have worked. They can qualify on their own. They have those 40 credits. They may not have made as much as the taxpayer, but they can qualify. So they're going to calculate their benefit first and figure out what that amount is. Then they're going to compare it to the taxpayer. If it's not as great as 1/2 of the taxpayers, they're basically going to increase that spouse to equal 1/2. So this is kind of something that it works on several different scenarios, because nowadays taxpayer and spouse can apply to either one. So it even works for as far as divorce. Taxpayer and spouse must be at least 62 years old. They must have been unmarried at the time they're filing. They must be unmarried, with their marriage to their taxpayer lasting at least 10 years. And they had to have been divorced from that taxpayer for a minimum of 2 years. So, if you're going down the checklist, and this is something that applies to you, you can apply for spousal benefits based on that taxpayer's earnings. And it's the same calculations they're going to run. If you can, if you can qualify on your own, yours might be greater just to take your benefit. But if it's not as great as 1/2 of the taxpayer, then you can draw on their benefits. The difference here is for divorce, the taxpayer's actions are not taken into consideration. Because a lot of times we get where the taxpayer might decide, because they've been divorced 5, 10, 20 years, taxpayer decides, I'm going to wait till I'm 70. The spouse is like, I need to draw when I'm 62 1/2. Well, it doesn't matter. The spouse doesn't need to even communicate with the taxpayer. It doesn't reduce the taxpayer's benefit in any way. It's completely separate. It's just a spousal benefit for divorced. I get a lot of questions on this. Is there any questions before I go on? Oh, here we go.
If the spouse has a retirement but was not eligible for Social Security, can they draw a spouse benefit?
Yes. Yes. So if like in this case, the spouse never worked a day.
Or the spouse has a federal retirement but was not on Social Security?
Correct. That's fine too.
Okay.
Yeah. They could still draw the spousal benefit and get one half of the taxpayers. Any other questions? All right. Now we'll jump into survivor benefits. How survivor benefits work, it's the same, currently married or divorced, so it's the same as the spousal benefits. You do get the benefit of this. And it also includes your family members. So now we're bringing in children possibly receiving benefits. So these benefits are based on the death of one of the receiving members of a couple. So you're going to hear it referred to as a widow or a widower's benefit. So during this, the couple was both receiving benefits. One of them passed away and the survivor is left. That survivor will now be eligible to receive either the benefit they were receiving or the larger, if the person who passed away, if their benefit was larger, they can switch over and take that benefit. Now, for this, the recipient must be 60 years old, and this is kind of where it gets a lot of confusing because now we're taking into account people that aren't even retirement age. So children of the deceased, if they're under the age of 18 and their parent passes away, those children, if they're under the age of 18, can receive a survivor benefit from the Social Security Administration. How about the spouse taking care of those children? Well, she can too, and there's no age restriction on her or them. There's no age restriction. So that's a good benefit to have. Now, as far as divorcees, that spousal, the rules do apply. The same 10 years, must have been married 10 years, divorced for 2. So these are in a nutshell how the survivor benefits work. So did I have any questions on survivor benefits? I'm going to talk a little bit about the planning of them because it's kind of important to see how you plan for survivor benefits. So planning for the survivor. So like I said, you generally receive the higher of their benefit or the benefit of the deceased. So this is what we're going to determine. Now, in my scenario, the taxpayer was a man and he passed away. Because 80% of women survive their husband on average by 14 years. So I'm not sure what happens. Like the wife has this rejuvenation of energy and lives a lot longer after their husbands pass away. But for a planning scenario, we need to really take this into account because 98% of widow benefit recipients are women. So the strategy that comes to my mind that, say in this scenario, the taxpayer was a man and he did pass away. Well, say he knew that he wasn't going to live past 70. He was in poor health. He just did not feel comfortable thinking he was going to live past 70. So most people would recommend you need to go down at 62 and file early. I know you're going to take a reduced benefit filing early, but that 8 years of reduced benefit is better than no benefit at all if you waited until you were 70. But then you got to look at his wife. Say she lives another 14 years. Well, if he files for that reduced benefit amount, that's what she will switch over to when he passes away, and now she's stuck for another 14, 20 years possibly on that reduced amount. So it may be more beneficial to wait till full retirement age, at least on the man, and get a bigger benefit that she can live on for the next 15 years. So this is some of the strategies that you see that start to come into play where you got to take both the husband and the wife into account. So I've talked a lot about delay, filing early. Found this little graph, and it basically shows that a person 66 years old in 2 months, that's their full retirement age. So say they file and their benefit is $1,300 a month. Well, if they were to wait and delay filing till they were 70, they get a 30% increase in their benefit amount. Now the graph works the other way also. If we were to file early, you can file as early as 62. If we were to do that, the graph goes down, probably ends up around the 850, 900 mark. if we file early. So you can see there's a 30% reduction or a 30% increase, all based on when you decide you want to file. So what criteria goes into the decision making of when to file for your Social Security benefits? Well, reasons to file early, you know, poor health, or you just need the income right now. That's just how it's working out. I got to have the income at 62, I'm going to file. Some good reasons to delay, possibly you're in good health or your spouse is in great health. You might want to be able to have an increased benefit there, or you're generating high income. So if you're in your 60s and that's some of the best income years of your life, you may want to continue working because, for one, it's going to increase that AMI we talked about, your monthly benefit, because they're taking those 35 years and averaging them. You could possibly be working a little longer, generating more income, and then delaying this to get that 8% return, because that's about what it works out to. Each year that you delay is about 8%. So really it comes down to, we need to determine how long you expect to live, and that's not something really fun to think about. But when it comes to retirement planning, Social Security planning, you need to have that, not only that picture of what you want your retirement to look like, but at what point that picture ends. Now, most of the strategies I've run, the delay strategies, you need to be possibly mid 80s to late 80s is what you kind of need to expect to live to for any of the delay strategies to really pay off. As with the, you know, full retirement, there's a lot of stuff that comes into play with full retirement on whether you need to file early or not, because there is some limitations that they put on if you're going to file early, which we're going to cover. Any questions on early, delay? So I mentioned working while on Social Security. Now, it only affects early benefits. So there's no restrictions once you reach that age that we all calculated earlier. Once you reach that age, there's no restrictions. So it's only the early benefits that get reduced. So if, say, you file early at 62, but you continue to work, if you cross this threshold of $16,920, they're going to start reducing your benefit, one for every $2 you go over that limit. Now, like I said, and then once you reach your full retirement age, the time prior to your birthday is where this comes in, the one out of every $3. But say same scenario, you filed at 62, you continue working, say you make $27,000. So you're about $10,000 over your limit as far as the Social Security, and you're drawing $10,000 in benefits from Social Security. Well, that $10,000 that you're over, they're basically going to take it one out of every $2, $5,000, and they're going to take it out of your benefits. So they're going to reduce your $10,000 in benefits down to $5, and they don't do it gradually. It's basically once you determine what your income was, that's when your Social Security check stops until you've made up that reduction in benefits. So it's important to understand that if you're still going to work and file early, you do face restrictions. Now, the only wages and self-employment income is the only thing that counts when we're coming up with this limit. So, you know, if you have pensions, if you start drawing from your IRA, selling investment stock, none of that goes into the calculation for that $16,000. It's just if you're working like a W-2 or you're staying self-employed that would affect this. And like I said, it may increase your lifetime earnings average if you continue to work especially past full retirement age. Now we're going to talk about the benefits and how they're taxed. Now how they're taxed, that lasts the rest of your life because, you know, only two things certain, death and taxes, and until you fulfill the first thing, you're going to have to worry about the second thing. So we have this provisional income. This is what's going to determine how much of your Social Security is taxable, because I'm sure you've heard that none of it is taxable or 85% of it is taxable. So that's a wide range. So basically we're going to build this pile called provisional income. So you're going to take half of the Social Security benefits that you're receiving, and you're going to put it in this pile. Then you're going to add in all the ordinary income you're making, pensions, IRAs, any of that. You're going to continue to add to this pile. Any kind of interest, dividends, capital gains, even non-taxable interest, which isn't normally taxed. You know, it's not going to be seen on your federal tax return for federal tax purposes. but they're going to include it in your provisional income. So that is your provisional income pile. So we've come up with this pile. We're going to count it, and then we're going to apply thresholds to it to see what portion of your Social Security is going to be taxed. So say that pile, you're single. I'll go ahead and pull the other one up here. You're single, and you're less than $25,000 is what your pile came up to. 0% of your Social Security is taxable. But once you go over that threshold, say you go over the $34,000 threshold, say you go, I don't know, 10,000 over that threshold, then 85% of that 10,000 that you went over is taxable. So as you can see, it doesn't take a whole lot of income before Social Security starts to be taxed. And you'll see in a scenario that I run here towards the end, a planning scenario of how big of a difference this makes on what we're going to put into this provisional income. Any questions on that? So retirement planning. So the first thing I think of is when we sit down to do retirement planning, first thing we're going to look for is a retirement planning calculator. Whether you go to a professional like Brandon, he's going to get his calculator that he's accustomed to using. He's going to ask you some questions. And then we're going to crunch some numbers because we're trying to figure out, we know you're in picture because you've told us what you want to retire like, you know, the lifestyle you want to have. We know where you're at right now. So let's run some numbers. Let's see how much we need to put back and save. And where, you know, when and where are we going to save this money? And this is where these buckets come into effect. Am I going to take the IRA bucket? And I've lumped these together because they're kind of taxed the same way. You're basically, if you have an IRA, a SEP, a simple, a 401k, those you receive the tax benefit up front. But then when you retire, you're responsible to pay the tax on those in that bucket. Or you could have the Roth IRA bucket where you don't get any tax benefit up front, but you get that income and it's not included because if you'll notice, it wasn't included in that provisional income. So here we have a Roth IRA that's not going to be included in provisional income, so it's not going to enable a lot of my Social Security to be taxed. Then we have other kinds of investments, you know, anything in securities possibly, even real estate investments that we need to take into consideration, and the health savings account, which I love, that take that into account. So we have all these different vehicles, all these different baskets that we can time and use. And I'll go ahead and let you know. I'm going to let Brandon talk here because I'm getting tired. My personal strategy is I would like to delay my Social Security benefits as long as possible because I really feel I'm going to live to be 100. I know I'm an optimist, but I just feel like I'm going to do that. So I want to delay and file at 70. So to do this, I've set up an IRA, which will enable me possibly to retire earlier and then draw off my IRA because all these IRAs have what they call a required minimum distribution, which you're going to hear kicks in at 70 and a half. And it requires you to withdraw so much out of that IRA. So then we have to take that, whatever that so much is, and put into that provisional income bucket, which increases the possibility of you paying tax on your Social Security. So I'm going to possibly live off an IRA before 70 years old, draw down those amounts to help me when I turn 70. I'll switch to my Roth, which is not included in any kind of provisional income. So then I'll be living off Roth, Social Security. I'll have some real estate, hopefully, still. It'll be worth something. And then health savings account, which is... I know. Yeah, I already got the chair. So and the health savings account, which I, receive the tax benefit up front by even contributing to one. And then I get to pay for all the medical expenses that's going to help me live to 100. And I get all that tax-free. So that's kind of my strategy, what I'm kind of trying to manipulate the numbers. I'm going to let Brandon talk a little bit about his thoughts on retirement.
You ready to take a break? Yes. Breathe. Clint's done a fantastic job today trying to put all these different, as you can see, there's a lot of moving parts to the puzzle. And what I've done for the last 18 years, the only career I've ever had, is financial planning. And I tell people all the time, it ends with an ING, and it's not a plan, it's planning. It's going to change. There'll be things throughout your life, events that'll happen. If you go Google retirement planning calculator, 1,000 things obviously will pop up. But in my opinion, think there's any replacement for sitting down with a human being that's their sole career and letting them use a retirement planning calculator for you and actually put all the different pieces of the puzzle together, because a lot of things we've been exposed to and situations that have happened in people's lives in the 18 years I've been doing it, my counterpart's been doing it 45 years, that you just can't even see potentially coming to fruition. But I think we don't charge anything to sit down with somebody on the very front end and try to help them map out a plan. And obviously we have to make some assumptions based on what the market's going to do and how long you're going to live and all those things. But again, that's why it's planning, because you don't just develop a plan and then never look at it ever again. Even when you get into retirement, there's all sorts of things that are going to happen that we need to adjust the plan as we go. And certainly things that can happen, like a spouse dropping out early, we need to plan for those on the front end. So I encourage you. I'm here on Tuesdays and Thursdays in Clarksville. I work out of an office downstairs, and would love to have an opportunity to sit down with anybody at any time and just help you kind of, even if you have a planner today, be glad to do a second opinion and say, hey, just let a fresh pair of eyes. But the younger you take the time to actually develop the plan, the better off you'll be long term. And there are, as y'all can see today, a lot of moving parts. So certainly think y'all, if anybody has questions for me, I'll be around afterwards and we'll be glad to answer any questions. Obviously, Clint's going to be around to answer questions. Got a wonderful staff here at Stoner Rolfe and Henry that know more about tax than I'll ever know. So any questions for me at this time? Okay. Clint, I'm going to hand it back to you, man.
Well, being the accountant in me, I had to put a graph in here with some numbers. So that way we can kind of use this example. And this is kind of what I was talking about as far as like my personal strategy. But you have taxpayer A. I know it's kind of hard to see. Taxpayer A and taxpayer B. Basically, we broke these two apart. Taxpayer A, you can see they get a little pension income, a little traditional IRA income, some Social Security benefits, for a total income of about $75,000 a year. Now, what of that is taxable? Of course, all $10,000 of the pension, the $35,000 from the IRA, and because of those thresholds, you can see $19,600 of that Social Security is taxable. So that leaves them with that $64,600 of taxable income by the time you move through your standard deduction for married, filed, and jointly, and your exemptions. Taxable income is $41,500, leaving you with $5,300 due in tax each year that you're retired. Now you move to taxpayer B. You can see they've used many more buckets. We've kind of spread this out a little bit better. We've got $1,000 of interest income. Of course, we have the tax exempt interest that doesn't apply as far as taxable income. You have your qualified dividends. Say they got stock that they're going to sell of $10,000 a year. Going to live off pension income, and their traditional IRA a much less amount because they've put some into a Roth IRA, quite possibly. So now you can see that $10,000 in traditional IRA is going to pick up $10,000 of taxable income, but the Roth IRA of $9,000 isn't even listed over there on the chart. We're not even including that. So now is when we reach the Social Security benefits, the same $30,000, because we still have that same $75,000 in income, but now only nearly half of taxpayer A was $37,700 is taxable. So now, once we run through our deductions and exemptions, we're stuck with $500 a year in tax. So that's a big difference when you're talking about a stage in your life where you may not be able to generate $5,000 extra a year to pay in tax. So you can kind of see how planning, looking at ahead, and creating a strategy is very beneficial. So any
Clint,
questions
just
on
to let
this?
them know, there is a full-size copy
Oh,
of
yes.
that in your folder, so if you need to go back and
Sorry,
reference
should've
that,
mentioned that.
that's okay.
I liked watching everybody squint at my little screen up here.
Go ahead, Gary.
My question would be, what would be passive income? So that, in other words, what is taxable and what is not?
So-
Let me, I farm
Correct. Okay.
as well, so is that a taxable?
That would be taxable income. Yeah, that'd be like ordinary income. And like passive, say you rented out your farm when you were done farming and you rented it to somebody else to farm. That would be like what you're referring to as passive income, but that's still taxable. We're still going to pick that up.
And so
Okay.
is rental property.
Correct. Yes.
The scenario that Clint has up here is something that, like I was saying, in retirement, you need to be trying to look at this every year or two, especially if there's special events that could be going on. And the wonderful thing about our strategic relationship is when we're doing these kind of meetings and we're talking strategy either before retirement or after retirement or during retirement, it's neat to be able to pull Clint into a meeting. It's neat to be able to pull Marcus into a meeting, pull Albert into a meeting with the clients, because we can have the tax team and the financial planning team all on one page and all together, doing the best thing for the client. And that's what's unique and fun about our relationship professionally. So it never stops. I mean, just because you retire, the laws are changing. Tax laws are changing. Congress has got to do something. So, well, they need to do something, but they're not really doing anything right now. They're in gridlock. But the laws change, and so the rules change. And as the rules change, we have to change. It's called planning. We've got to change the plan.
Have any other questions about anything? Well, anything that applies to Social Security. Yeah, Social Security and financial planning questions, thoughts or comments? So, nothing. Well, that's all I have.